Most people do know where their retirement accounts are, so the big issue for them is making sure their investments are working for them in a way that meets their long-term retirement goals. Now, in between some fits and starts, we've seen some steady upward movement in the stock market this year, so if you haven't checked your account in the last few months, chances are you may need to rebalance some of your holdings. Joining us this evening for more on this is Doug Flynn. He's the co-founder of Flynn Zito Capital Management in Garden City, New York. I'm still paying attention to that last report. I can't believe how much money is actually sitting around in these accounts. Do you ever run into this? Do people have money that they didn't know they had?
Sometimes. I actually run into it on the business owner side. The clients that we have that are business owners that offer a 401k, they have a worker that no longer works for them. They can't locate them. They want to give them money and they can't even find them to give them money. And the money's in the plan and the business owner is paying the fees on the 401k to keep that money in there. So I do run into it.
Wow. Let's talk about those of us who do know where our money is. I want to show our viewers, this is the return on three key indices, 1 year return from last August to now. The S&P 500, which is the broadest index, Doug, that most people invest in, is up 16.9% over the last 12 months. Not this year, but over the last 12 months. I want to talk to you about two other indices, the EAFE, which is international stocks, up a little less than 10% over the same period, and the Russell 2000 just over 10%. The Russell 2000 is small caps. Now let me just change screens and let my viewers see small cap stocks and how they've performed compared to the S&P 500. And you can see here, this green line here, why'd they make them both green? This one here is the S&P 500. This bluish one is the small cap. So what does that tell you, Doug?
Well, you can see it's a little bit more volatile on the smaller cap issues, and that's because they're a little bit more aggressive. They have more growth to them, perhaps less dividends. But what it tells you is that right now you have a situation where smaller companies have underperformed the larger companies. If you look historically, that isn't the case. You typically do get outperformance over time from the smaller companies because you're taking a little more risk, and therefore you should be rewarded over a period of time because they're going to grow faster than the large companies would. But that has not happened over the last 12 months.
I'm going to talk to you more in a minute about what you're supposed to do about it, but I want to show my viewers this chart. This is a different one. This is the EAFE, which is international markets. Don't worry about what the initials stand for, versus the S&P 500. Once again, the S&P 500 is in green, and in this case, the international index is in blue. They've tracked each other for much of the last year, and then they started to separate. International markets now much lower on an annual basis, about, like as I said, about 10% versus 16%. Tell me about that.
That's true, and you had seen what we call correlation when the markets are acting in tandem. When the U.S. went up, they went up, and vice versa. But you're starting to see a little bit of divergence there, and there are times when that happens. But also here, internationally, you should expect greater return for the additional risk that you're taking. And yet over the last 12 months, this is another one of those anomalies where it's underperforming. So what that sets up for are opportunities, especially because when you have a period of underperformance, it oftentimes is followed up with a period of outperformance on the other side.
Now, obviously, anybody watching this thinking about their own portfolio should really make determinations as to what kind of investor they are, what their risk tolerance is, what their time horizon is until they have to start using that money. But let's assume, for purposes of a moderate investor, and I've put up a sample moderate risk asset allocation, what you sort of think it should be in. You're recommending 30% in large cap U.S. stocks, the ones that you mostly hear about talked on TV, 15% in non-U.S. or international stocks, 10% in small and mid cap, 35% in bonds and fixed income, and 10% in alternatives. Tell me why.
Well, the mix there is really, if you had set your allocation, this is a typical moderate investor, someone who's looking, you can accept a moderate amount of risk for the return. And an oversimplified version of this might be 60% stocks. This is, with alternatives, it's a little bit less. But what you're doing is you're trying to not put all your eggs in one basket. You're not trying to have all U.S. blue chip names. Now, that's where you might be the most familiar. That's what you're most comfortable with. But as we just saw, if you had that, you had outperformance in that area and some underperformance in the other categories. And so when you rebalance, you are going to take advantage of buying into some of those areas that haven't performed as well over the last 12 months. But you want to have international stocks, you want to have some smaller companies, because over a long period of time, they do tend to outperform the U.S. At various points. And when they underperform as they have lately, that is one of the reasons why you might consider now a good time to do your rebalancing.
Let's talk about the S&P 500. It has been 1,000 days, basically, since October of 2011 that the Dow has not had a what they call a correction, a 10% drop or greater, and that's the fifth largest stretch of that sort in 50 years. Are you betting that the market pulls back, or do you just want your clients to sort of understand that this is a particularly long stretch without a pullback?
That is a long stretch, and so while we keep expecting and maybe saying at some point we're going to have this correction that everyone keeps calling for, you shouldn't necessarily wait for that to happen before you do your rebalancing. Now, I would put to you that if you did your rebalancing to your original allocation and there was a major market pullback, there's nothing wrong with getting in there, especially in your 401k. It's typically one button or a phone call where you can say, could you please rebalance my portfolio? Oftentimes it's not free, and oftentimes it is free, and many times you can put that into a 401k if it's not offered there, an automatic rebalancing schedule to keep you on track. So you can always pull the trigger if there is that 10% pullback that is overdue, but it might not happen. The market might keep moving, and therefore this is one of those times when you do want to reallocate. We found in the summer, especially August is probably the worst month of all the calendar months each year. If you look at it, over the last 25 years, it's the worst month. And September and October are typically weaker months. And then you have this great run typically from November through April in the market. So sometime here in the next couple of months, this is one of the things that you want to do. And diversifying, as you know, is very important.
Doug, always good to see you. Thank you so much for being with us. Doug Flynn is the co-founder of Flynn Zito Capital Management.